Hello everybody, welcome to this discussion about IAS 1 and we're going to be treating a question to show the practical aspects of IAS 1. Now of course IAS 1 is the standard that deals with presentation of financial statements, and in your previous session you would have gone through some of um, the chapters of IAS 1, the chapter that talks about offsetting, the chapters that talk about going concern and a lot of that. But obviously IAS 1 tells us what is contained in each component of the financial statements. So if you remember that we have 4 financial statements plus the notes, that is what gives us 5. Okay, starting from the statement of financial position, going to the statement of comprehensive income, to the statement of changes in equity, the statement of cash flows, and notes. All right, now the statement of cash flows, the presentation of the statement of cash flows is not dealt with by IAS 1, it is dealt with by IAS 7, and that will be treated on a different day. However, what is meant to be contained in all the other statements are treated by IAS 1. So beginning from the statement of financial position, which is meant to show assets and liabilities. Now, in a statement of financial position, IAS 1 allows you to present assets and liabilities, okay, using the total assets method, or using the net assets method. The total asset method is what you will find if you look at the financial statements of any institution that you will find in the EU, in the US, in Nigeria, that is post 2011. But not all institutions in Nigeria, but most larger institutions will, after having adopted IFRS, will present under the total assets method. The net assets method, you will still find the net assets method in use in the UK. Alright, and what is the difference between the two? The total assets method lists all the assets and then finds up the total assets. Then it lists all the equity and finds the total equity. Then it lists all the liabilities and finds the total liabilities. Then we add the total equity and total liabilities together, and of course the result that we have will be in agreement with our total assets figure. The net assets method lists assets on one side, then subtracts all the liabilities from the assets, and then gives us net assets. Then equity is shown on the other side and we find total equity. And then the result of total equity should be the same as the results of the assets minus liabilities. Alright, so that is the first point to note. Now, and then when it comes to classification in the statement of financial position, items, that is assets and liabilities, are classified between current and non-current. Unless presentation by liquidity will provide more relevant information. Now, again, if you look at the financial statements of any organization that is not a bank or similar financial institution, their statement of financial position will be classified into current assets and non-current assets. But the financial statement of a bank, you will find no such classification. All you find is just um, all the assets being listed from the least liquid to the most liquid, or from the most liquid to the least liquid, with the most liquid of assets, okay, being cash, whether in the vaults, okay, or in deposits with other bank, and the least liquid being intangible assets like goodwill. Now, even if you're classifying by current and non-current, classification even if you're classifying assets into current and non-current, um, it is still accepted that even within these classes, the items presented will still be arranged in order of liquidity, from the most liquid to the least liquid, or from the least liquid to the most liquid. Now, liabilities as well are also presented in order of liquidity, but this takes up a slightly different meaning. When we say in order of liquidity for assets, we mean which assets are most readily convertible into cash. But when we say in order of liquidity for liabilities, we mean which assets, which liabilities are going to be are likely to be paid sooner rather than later. So if you have bank overdraft, okay, which is repayable on demand, that will be the most liquid liability, the most pressing liability. And then of course long-term provisions, okay, will of course be the least liquid. So it makes sense for a financial institution for their assets and liabilities to be presented in order of liquidity, such that at a glance, users can know what assets are available and what liabilities are most pressing. And if the user nets out the most pressing liabilities against the most available assets, is the short-term position of the bank healthy? And likewise, compare the long-term position of the bank as well. The next video will discuss the statement of comprehensive income before we even begin to solve the question. Thank you.